Question 1. Mr. Stevens is a 63-year-old retiree considering purchasing a variable annuity. He has a moderate risk tolerance and wants to ensure that his retirement savings continue to grow while also having some protection against market volatility. Which of the following options would be most suitable for Mr. Stevens considering his goals and risk profile? A. A fixed annuity with a guaranteed interest rate. B. A hybrid annuity that combines fixed and variable features. C. An immediate variable annuity with no death benefit. D. A single premium equity indexed annuity. Answer: B. A hybrid annuity that combines fixed and variable features. Explanation: a hybrid annuity would best suit Mr. Stevens because it offers a combination of both fixed and variable features, giving him the potential for market-linked growth through the variable component while providing the stability of a fixed interest rate. Given that Mr. Stevens has moderate risk tolerance, this balance aligns with his goals of growth and market protection. The other options are not as suitable. A fixed annuity A provides stability but doesn't offer growth potential tied to the market. An immediate variable annuity C might expose him to more risk than he desires, and an equity indexed annuity D might have caps and participation rates that limit returns. Question 2. Which of the following best describes the tax treatment of annuities during the accumulation phase? A. The interest earned in the accumulation phase is tax-free until withdrawn. B. Taxes are paid on annuity payments as they are earned during the accumulation phase. C. Taxes on earnings are deferred until the withdrawal phase or upon surrender. D. Taxable interest is calculated and paid annually based on the contract's interest rate. Answer: C. Taxes on earnings are deferred until the withdrawal phase or upon surrender. Explanation: annuities are structured to provide tax deferral during the accumulation phase, meaning taxes on the earnings, interest, dividends, and capital gains are not due until the funds are withdrawn or the contract is surrendered. This deferral allows the money to grow without immediate tax burdens. The other options are incorrect because they either suggest taxes are due annually, B, D, or imply the earnings are tax-free, A, which is not the case. Question 3. During an annuity sale, an agent must ensure that the recommended product aligns with the client's financial goals and needs. Which of the following practices is not in compliance with Indiana's annuity suitability requirements? A. Recommending a high commission annuity product without considering the client's risk tolerance. B. Completing a needs analysis to determine if an annuity matches the client's long-term financial objectives. C. Disclosing all fees and charges associated with the annuity product. D. Offering a product that provides income for life, which aligns with the client's retirement needs. Answer: A. Recommending a high commission annuity product without considering the client's risk tolerance. Explanation: under Indiana's annuity suitability requirements, agents are required to conduct a thorough needs analysis to determine the product's appropriateness based on the client's risk tolerance, financial goals, and needs. Recommending a product based primarily on high commission without considering these factors is not compliant with suitability regulations, which prioritize the client's best interest. The other options, B, C, D, are compliant with suitability standards as they involve proper assessment, full disclosure, and a product that aligns with the client's retirement needs. Question 4. Which of the following is a key characteristic of equity indexed annuities? A. Offer a fixed interest rate with no market risk. B. The return on any is based on the performance of a stock market index with caps and participation rates. C. Guarantee a fixed payment regardless of market performance. D. The annuity's interest is solely dependent on bond market performance. Answer: B. The return on any is based on the performance of a stock market index with caps and participation rates. Explanation: equity indexed annuities are linked to the performance of a stock market index, e.g. SP 500, but the returns are subject to caps and participation rates. This means the potential for growth is tied to market performance, but with limits to the upside. The other options are incorrect because A. does not reflect the market connection of IAs, C. misrepresents the flexible nature of their returns, and D. is incorrect because IAs are linked to stock markets, not bonds. Question 5. If an annuity contract has a 10-year surrender period with a 7% annual penalty and the annuitant decides to withdraw funds in the third year, how much would the penalty be on a withdrawal of $100,000? A. $7,000. B. $30,000. C. $21,000. D. $3,500. Answer: A. $7,000. Explanation: the penalty is based on the percentage of the amount withdrawn, in this case 7% annually. If the annuity is withdrawn in the third year, the penalty for the $100,000 withdrawal would be 7% of that amount, which equals $7,000. The other answers are incorrect because they represent either an incorrect percentage or an incorrect application of the penalty rate. Question 6. Which of the following is a common rider found in annuity contracts that ensures the annuitant has access to funds in case of long-term care needs? A. Guarantee minimum income benefit (GMIB). B. Long-term care rider. C. Death benefit rider. D. Guarantee minimum withdrawal benefit. Answer: B. Long-term care rider. Explanation: the long-term care rider is an optional feature that can be added to an annuity to allow for accelerated withdrawals in the event of the annuitant needing long-term care. The GMIBA ensures a minimum income regardless of market conditions. The death benefit rider (C) provides a death benefit to the beneficiary, and the GMWB guarantees a minimum withdrawal amount, but none of these are specifically for long-term care. Question 7. What is the primary purpose of the free look period in an annuity contract? A. To allow the annuitant to cancel the contract within a specific time frame and receive a full refund of premiums paid. B. To provide a period during which the annuitant can select the most beneficial payout option. C. To give the annuitant an option to switch between different types of annuities. D. To allow the insurance company to reassess the annuitant's eligibility for the annuity contract. Answer: A. To allow the annuitant to cancel the contract within a specific time frame and receive a full refund of premiums paid. Explanation: the free look period is a consumer protection provision that allows the annuitant to cancel the annuity contract within a specified time, usually 10 to 30 days, and receive a full refund of any premiums paid with no penalties. This period allows the client to review the terms of the contract before fully committing. The other options are incorrect as they do not align with the purpose of the free look period. Question 8. In a fixed annuity, the insurer guarantees a minimum interest rate, but the actual rate can be higher depending on the market conditions. Which of the following is a key risk that the annuitant faces in such an annuity? A. Inflation risk. B. Longevity risk. C. Liquidity risk. D. Market risk. Answer: A. Inflation risk. Explanation: inflation risk is the primary concern with fixed annuities that offer a guaranteed minimum interest rate, as the fixed rate may not keep up with inflation over time. While the annuity may perform better in certain market conditions, the annuitant may face reduced purchasing power if inflation outpaces the guaranteed rate. Longevity risk. B. Refers to the risk of outliving the annuity. Liquidity risk. C. Involves early withdrawal penalties. And market risk. D. Applies more to variable annuities. Question 9. Which of the following is not a characteristic of a variable annuity? A. The contract value fluctuates based on the performance of the underlying subaccounts. B. The annuitant can choose between a fixed or variable payout option. C. The insurer guarantees a fixed minimum return regardless of market performance. D. The annuitant assumes the investment risk for the growth of the annuity. Answer: C. The insurer guarantees a fixed minimum return regardless of market performance. Explanation: variable annuities do not guarantee a fixed minimum return. The contract value fluctuates based on the performance of the underlying subaccounts, and the annuitant assumes the investment risk. A fixed return is more typical of fixed annuities. The other options are characteristics of variable annuities, where the annuitant can choose a payout option B and assumes the investment risk D. Question 10. What is the tax treatment of withdrawals from a non-qualified annuity before the age of 591? A. Withdrawals are subject to ordinary income tax and a 10% early withdrawal penalty. B. Withdrawals are taxed at a lower capital gains rate. C. Withdrawals are tax-free as long as the annuity is held for at least 5 years. D. Withdrawals are subject to ordinary income tax but no penalties applied. Answer: A. Withdrawals are subject to ordinary income tax and a 10% early withdrawal penalty. Explanation: withdrawals from non-qualified annuities before age 591 were generally subject to ordinary income tax, and an additional 10% early withdrawal penalty applies to the earnings portion of the withdrawal. The other options are incorrect. B refers to capital gains tax, which is not applicable for annuities. C is not a tax rule for annuities, and D is incorrect because early withdrawals typically incur penalties. Question 11. Which of the following annuity types provides income that can increase over time to help combat inflation? A. Fixed annuity. B. Immediate annuity. C. Variable annuity. D. Inflation-indexed annuity. Answer: D. Inflation-indexed annuity. Explanation: an inflation-indexed annuity is specifically designed to adjust payments over time based on inflation rates. This helps the annuitant maintain their purchasing power. Fixed annuities: they provide a fixed amount of income. Immediate annuities: B. Start paying income immediately. And variable annuities: C. Provide income that fluctuates based on market performance, but none directly address inflation adjustments like an inflation-indexed annuity does. Question 12. Which of the following statements about a deferred annuity is true? A. Payments begin immediately after purchase. B. The contract grows tax deferred until withdrawals begin. C. Payments are fixed and cannot be adjusted. D. The annuitant must begin receiving payments within 1 year of purchase. Answer: B. The contract grows tax deferred until withdrawals begin. Explanation: a deferred annuity allows the annuitant to defer taxes on the investment gains until withdrawals are made. This is a major advantage for those looking to grow their funds in a tax-deferred environment. In contrast, immediate annuities, they begin payments immediately. Fixed annuities, C, are not always the case for every type of annuity, and the annuitant in a deferred annuity, D, does not need to start withdrawals within a year. Question 13. Which of the following is not typically a benefit of a variable annuity? A. Potential for higher returns due to market exposure. B. Guaranteed minimum death benefit. C. Fixed payouts regardless of market conditions. D. Access to a wide range of investment options. Answer: C. Fixed payouts regardless of market conditions. Explanation: variable annuities are linked to market performance, meaning payouts fluctuate based on the performance of the subaccounts. They offer the potential for higher returns. A guaranteed minimum death benefit. B. An access to various investment options. D. Fixed payouts regardless of market conditions. C. Is characteristic of fixed annuities, not variable annuities. Question 14. In which of the following cases would an annuitant likely face surrender charges? A. When annuity payments begin. B. When the annuitant withdraws more than the allowed free amount during the surrender period. C. When the annuitant passes away during the surrender period. D. When the annuitant reaches the age of 591. Woe. Answer: B. When the annuitant withdraws more than the allowed free amount during the surrender period. Explanation: surrender charges are fees applied when the annuitant withdraws funds during the surrender period, which is a time frame in the early years of the annuity contract. The penalty applies if withdrawals exceed the free withdrawal limit. If the annuitant passes away, C. Death benefits are typically not subject to surrender charges. Reaching age 591 D relates to early withdrawal penalties, but is not specific to surrender charges. Question 15. Which of the following is a common characteristic of an immediate annuity? A. Payments begin after deferral period. B. The annuitant can choose from a variety of investment options. C. Payments begin immediately after purchase. D. The annuity grows tax deferred. Answer: C. Payments begin immediately after purchase. Explanation: an immediate annuity begins making payments to the annuitant right after the contract is purchased. This is different from deferred annuities, where payments start after a deferral period. Immediate annuities do not offer investment options. B. And do not grow tax deferred. D. Since they are designed to pay out immediately. Question 16. Which type of annuity is most suitable for an individual who wants guaranteed income for life with no investment risk? A. Variable annuity. B. Fixed annuity. C. Indexed annuity. D. Immediate annuity. Answer: B. Fixed annuity. Explanation: a fixed annuity offers guaranteed payments for life or for a specified period with no exposure to investment risk. It provides the stability of fixed payments regardless of market conditions. Variable annuities, they have market risk. Indexed annuities, C, are tied to market indexes, and immediate annuities, D, begin paying immediately but are often part of the fixed annuity category. Question 17. Which of the following statements is true regarding the payout options of an annuity? A. The annuitant can only select a lump sum payment option. B. The annuitant can choose either a fixed or variable payout option. C. Payouts are always based on the performance of the insurance company. D. The payout option can be changed at any time during the annuity's life. Answer: B. The annuitant can choose either a fixed or variable payout option. Explanation: annuities typically offer a range of payout options, including fixed or variable payouts, depending on the type of annuity. Fixed payouts provide a predetermined income, while variable payouts fluctuate based on market performance. Payouts are not based on the insurance company's performance. C. And the option cannot generally be changed once chosen. D. Question 18. What does the premium payment in an annuity contract refer to? A. The periodic amount the annuitant receives as income. B. The lump sum or periodic contributions made to fund the annuity. C. The fees charged for annuity management. D. The interest earned on the invested annuity funds. Answer: B. The lump sum or periodic contributions made to fund the annuity. Explanation: the premium payment is the amount that the annuitant contributes to purchase the annuity, either as a lump sum or through periodic contributions. This is the money that the insurance company invests, and the annuitant will eventually receive income payments based on this premium. The other options relate to the income payments, fees, or investment earnings, but not the premium itself. Question 19. Which of the following annuity riders provides a guaranteed minimum income regardless of the performance of the annuity's investments? A. Guaranteed minimum income benefit (GMIB). B. Guaranteed minimum withdrawal benefit. B. A long-term care rider. D. Death benefit rider. Answer: A. Guaranteed minimum income benefit (GMIB). Explanation: the GMIB rider guarantees the annuitant a minimum income for life, regardless of how the investments in the annuity perform. This rider ensures that even if the investments perform poorly, the annuitant will still receive a baseline income. The GMWB offers a guaranteed withdrawal, but not necessarily as income, while the long-term care rider (C) and death benefit rider (D) serve other purposes. Question 20. What is the annuitization process in the context of an annuity? A. The process of converting the annuity contract into a lump sum payment. B. The process of transferring the annuity to a beneficiary after death. C. The process of beginning the periodic income payments from the annuity. D. The process of determining the interest rate used in the annuity contract. Answer: C. The process of beginning the periodic income payments from the annuity. Explanation: annuitization is the process of converting the accumulated value of the annuity into periodic income payments, typically for a specified period or for the annuitant's lifetime. It marks the point when the annuitant begins receiving income. The other answers refer to actions that are not part of the annuitization process, such as lump sum payments. A. Beneficiary transfers. B. An interest rate determination. D. Question 21. Which of the following is true about a life annuity with period certain? Option A. Payments are made for a set period after which the contract ends. B. Payments are made for life, but the amount of each payment fluctuates. C. Payments are made for the lifetime of the annuitant with a guaranteed minimum period. D. Payments can be increased based on the performance of the investment portfolio. Answer: C. Payments are made for the lifetime of the annuitant with a guaranteed minimum period. Explanation: a life annuity with a period certain guarantees income for the annuitant's lifetime, but also ensures that if the annuitant dies before a set period, e.g. 10 years, the remaining payments will continue to a beneficiary for that guaranteed period. Option A describes a fixed period annuity. B refers to a variable annuity, and D refers to a variable payout feature not specific to life annuities. Question 22. Which of the following would likely be a good use for a deferred annuity? A. To provide income immediately after retirement. B. To accumulate retirement savings on a tax-deferred basis. C. To ensure fixed income for the next 5 years. D. To invest in the stock market without any risk. Answer: B. To accumulate retirement savings on a tax-deferred basis. Explanation: deferred annuities allow individuals to accumulate funds for future use, such as retirement, on a tax-deferred basis. This means the earnings grow without being taxed until withdrawn. Option A is more suited to an immediate annuity. C applies to fixed-period annuities, and D is inaccurate, as annuities are not without risk, especially if they are variable. Question 23. Which of the following is a risk associated with a variable annuity? A. The annuity payments may decrease if the market performs poorly. B. The annuity payments will always be higher than fixed annuities. C. There are no fees or charges associated with a variable annuity. D. The annuitant will lose the ability to change investment options. Answer: A. The annuity payments may decrease if the market performs poorly. Explanation: variable annuities have payments that are tied to the performance of underlying investments. If the market performs poorly, the payments could decrease, which introduces investment risk. Option B is not guaranteed, since variable annuities may offer lower returns depending on market conditions. Option C is incorrect, as variable annuities typically have fees, and D is not true because annuitants can usually change investment options. Question 24. What is the accumulation phase in an annuity contract? A. The period during which the annuity pays income to the annuitant. B. The phase in which the annuitant makes premium payments to the insurer. C. The time during which the annuitant's payouts are fixed. D. The phase when the insurance company invests the premiums into equities. Answer: B. The phase in which the annuitant makes premium payments to the insurer. Explanation: the accumulation phase is when the annuitant is making contributions either as a lump sum or periodically to the annuity. During this phase, the annuity's value grows either through interest or market performance, depending on the type of annuity. The other options refer to the annuity's payout phase or investment actions, but they do not describe the accumulation phase. Question 25. Which of the following is a characteristic of an indexed annuity? A. Payments fluctuate based on the performance of the stock market. B. Payments are based on a fixed interest rate set by the insurance company. C. Payments are linked to a stock market index, such as the S&P 500. D. Payments are fixed and guaranteed for life. Answer: C. Payments are linked to a stock market index, such as the S&P 500. Explanation: an indexed annuity ties its interest credits to the performance of a stock market index, e.g. S&P 500, but it typically includes caps or participation rates to limit potential returns. The other options describe characteristics of fixed, B. variable, A. and life, D. annuities, but not indexed annuities. Question 26. In a variable annuity, what determines the amount of income the annuitant receives? A. A fixed interest rate. B. The annuitant's life expectancy. C. The performance of the selected investment portfolio. D. The amount of premium paid. Answer: C. The performance of the selected investment portfolio. Explanation: in a variable annuity, the amount of income received depends on the performance of the investments chosen by the annuitant, such as stocks, bonds, or mutual funds. The performance of these investments will determine the payout amount. The other factors do not directly influence the income, as variable annuities are subject to market risk. Question 27. What is a death benefit rider in an annuity contract? A. A guarantee that the annuitant will receive a fixed payout. B. A provision that ensures the annuitant's beneficiaries receive a death benefit if the annuitant dies during the accumulation phase. C. A guarantee that the annuitant will not lose money. D. A provision that allows the annuitant to withdraw funds at any time without penalty. Answer: B. A provision that ensures the annuitant's beneficiaries receive a death benefit if the annuitant dies during the accumulation phase. Explanation: a death benefit rider guarantees that if the annuitant dies before annuitization begins, the beneficiary will receive at least the premium paid or a minimum value as a death benefit. This rider protects the annuitant's family from loss in the event of early death. Option A refers to income guarantees, C is not a typical feature, and D relates to withdrawal provisions. Question 20. Which of the following would be most suitable for someone seeking flexibility in both income and investment options in an annuity? A. Fixed annuity. B. Variable annuity. C. Immediate annuity. D. Inflation indexed annuity. Answer: B. Variable annuity. Explanation: a variable annuity offers the most flexibility as it allows the annuitant to choose from various investment options, stocks, bonds, mutual funds, and adjust their portfolio over time. It also provides flexibility in income as payments can vary based on the performance of the investments. Fixed annuities offer predictable income but no investment options. Immediate annuities start paying income immediately without investment flexibility. And inflation-indexed annuities adjust for inflation but still do not offer significant investment flexibility. Question 29. What does a fixed period annuity offer? A. Payments that continue until the annuitant's death. B. A predetermined number of payments over a set period. C. Payments that are just based on the market performance. D. Guaranteed payments that increase over time. Answer: B. A predetermined number of payments over a set period. Explanation: a fixed period annuity pays a set amount of income over a predetermined period, regardless of whether the annuitant lives or dies during that time. This differs from a life annuity, which continues until the annuitant's death. Option C describes a variable annuity, and D is a feature of some inflation-adjusted annuities. Question 30. What is a guaranteed minimum withdrawal benefit to be? A variable annuity. A rider that guarantees the annuitant will receive at least a certain percentage of their premium as income. B, a provision that allows the annuitant to withdraw money without penalties. C, a rider that guarantees the annuitant's investments will not lose value. D, a guarantee that the annuitant will receive their original premium back upon death. Answer A, a rider that guarantees the annuitant will receive at least a certain percentage of their premium as income. Explanation: the GMWB rider ensures that the annuitant can withdraw a certain percentage of their premium, typically as a lifetime income stream, even if the underlying investment values fall. This rider protects the annuitant from market downturns, though the annuitant may still lose principal. Option B relates to withdrawal flexibility. C is not typically guaranteed, and D refers to a death benefit, not a withdrawal guarantee.